Good morning. We will pay attention to the cash flow statement. In this recording, we will pay attention to the note that you have to complete between the taxation and the generation from operations. That means the profit before tax plus interest plus depreciation and your current assets. So this note will show the total inflow or outflow of money as a result of current assets, current liabilities, and income and expenses. And we will also prepare the cash flow from operating activities section in the cash flow statement. If we look at the information that they give us, they say the authorized share capital is 900,000. So that's not the amount that was already issued. That's the total amount that they can have, and that will consist of 450,000 shares sold at R2 each. New shares were issued on the first day of the financial year. That means if there's any interim or final dividends, the new shares will also receive the dividend on the number of shares that was issued. We have to do the note and the tax and dividends note as well. To complete this first note on cash flow, it means that we have to look and see what is the inflow or outflow as a result of income and expenses. All my income and expenses are recorded in the income statement. Therefore, I will go to the income statement and see what is the information that's given to me there. They give me the profit for the year after tax. I need the profit before tax because tax will be shown separately what the inflow outflow is. Therefore, I will have to add the income tax to the net profit that was given to me to determine what is the net profit before tax. So I will add the 90,000 and the 60,000 to get the total net profit before tax. Now, in your income statement, all income and expenses are written down. Interest is one of the expenses that's recorded in your income statement. But according to the Companies Act, interest must be shown separately on the cash flow statement. So I don't want to show that there's an outflow of money as a result of this interest in this section because it will be shown separately. Therefore, I will have to add the interest on loan back. So it means I will take my profit before tax plus that interest. Then depreciation is not an outflow of money. Depreciation was also indicated in the income statement as a reduction of my profit. Because it's not an outflow of money, it means that I must add back the depreciation so that I can see what is the flow of money. So I'm only using my profit before tax as a stepping stone to say that is the profit between income and expenses, and then I will do reverse entries for depreciation because it didn't cause a flow of money, and for interest because it's shown separately on the cash flow statement. So in the note for reconciliation between profit and tax generated by operations, we will take the profit after tax, add the tax to it, and that will give me the total of 150,000. For depreciation, they gave me the depreciation in the note and they gave me the interest. So the interest I will add back and the depreciation I will add back. I will show the calculation for depreciation if it's not given that you know how to calculate it. Then I will add these three figures together to see what is my total profit or inflow of money before we take our other current assets and current liabilities into account. The first change will be in inventory. So we will look in your balance sheet, and the difference between the inventory for the current year and the inventory for the previous year will show us the inflow or outflow of money. In the current year, the inventory decreased. Now, why did inventory decrease? Because we sold the inventory, and if we sold the inventory, money came into the business. So if I subtract these two figures, I see that there was an inflow of 28,000 Rand because we sold the goods. Okay, for the debtors and the creditors, we have to go to the note to see what is the total amount and then determine what is the difference between the current year and the previous year. Okay, if we look at the trade debtors, the total amount on the balance sheet consists of trade debtors, SARS income tax. SARS is shown separately because we show the outflow of money as a result of tax separately. So I will take the debtors plus the accrued income plus the prepaid expenses for both years and deduct that from each other to see what is the movement. For the creditors, we will take into account the creditors. SARS income tax is shown separately. Accrued interest will be shown separately, so you will not add it here. Accrued expense is a normal expense that will be added. Shareholders for dividends will not be added. If we look at the debtors, we will see that the amounts that we have to take into account as the movement for debtors between the previous year and the current year is the amount owed by debtors. It was 34,000, now it's 23,000, so that means the debtors owe us less money, and that caused an inflow of 11,000. Accrued income is also a current asset. We think it out the same as debtors. So if my debtors increased, it means that I financed them and my money went out of the business. Or I can say the previous year we had 500 Rand as accrued that didn't come in time. Now we've got 800 Rand, so there was not the necessary inflow of money. That's why we show it as an outflow. Prepaid expenses, well, we think out like debtors. So because the prepaid expense decreased, it means that the debtors paid, so we have an inflow of money. Or I can say I've got less prepaid expenses, so I paid out less money than I paid the previous year, so therefore it will be an inflow of money. And then I add them together to see what is my total amount for inflow between all the previous year and the current year's amounts for debtors. For creditors, we will also compare the previous year with the current year. Included in the note for creditors is the amount owing to creditors. Last year it was 63,000. This year it is 54,000, so we owe less money to the creditors. So we paid out 9,000 Rand, and there was an outflow of 9,000. Accrued expense is, you think out exactly the same as creditors. It was 700, it's 800. That means that they financed us, so it's an inflow of 100. Or I say my accrued expense increased, so I paid out less money than the previous year, so it means that money, the 100 Rand, was not an outflow. When I add them, I see what is the total amount that went out of the business for creditors. In my note, I will show that there was a decrease in debtors, so there was an inflow of money. There was a decrease in creditors. That means that we paid the creditors. That was an outflow of money. Then I will add these together to see what is the total change, and I will add the operating profit and the change together to see what is the total cash generated by operations. Okay, so the total amount cash generated by operations will be transferred to the cash flow statement to show that that was the total inflow of money as a result of income, expenses, current assets, and current liabilities that is not disclosed separately. And we will show this amount as cash generated from operations is 236,100. And then we have to show what is the amount for interest paid, tax paid, and dividends paid. So we have to do a calculation for each one of these. Interest paid, if there was no accrued amounts, will be the same amount as we have on the income statement. If there are accrued amounts for interest or prepaid amounts, you will have to complete a ledger account to do the calculation. If we look at the note for creditors, we see that there's accrued expense for interest. So we have to take into account that at the end of the previous year it was 300 Rand, and at the end of the current year it is 400 Rand. Before I do the calculation for the current year, I first want to explain this concept of accrued expense. If we look at our calculation accounts that I'm going to do with you now, you will see that the interest expense at the end of February 2016, we paid out, say for instance, 10,000 Rand. Then at the end of that year, we had an accrued amount of 300, indicating that we didn't pay out all the money that we were supposed to pay out. So I increased my expense and I increased my liability with 300 Rand. Then I calculated the total amount for interest for the year, and the total amount was transferred to the profit and loss account. And I closed my interest expense account because the debit side and the credit side was the same. At the beginning of the next financial year, that means on the 1st of March 2016, we have to do a reverse entry for this 300 because this accrued expense account is a bridging account that's only valid for 1 day. So that means it's got a credit balance. I will have to debit this account so that I can close this accrued expense account at the beginning of the year. And because I debit accrued expense, I will credit my interest expense account with the 300 Rand, indicating that we owe 300 Rand at the beginning of the year. So the first time that we make payments, we will pay out that 300 Rand, and that will be included in this bank amount. Now we don't know what is the bank amount for the current year, so this is the one that we will calculate by balancing to record it in the cash flow statement. At the end of the year, they said to us that the accrued expense was 400 Rand. So that means we owed 400 and we transferred that 400 to the liability account to show that we owe 400 that will be recorded in the balance sheet. In the income statement, the amount for interest was 12,900 Rand. That means that the total amount on the credit side is 13,200 Rand. If I deduct the 400 on the debit side, the balancing figure, that means the difference between the debit and credit side, will be 12,800, indicating that that was the outflow of interest during the current financial year. If we look at our interest expense account that we will open for this specific question, we see that there's accrued expense at the beginning of the year. Now, in this example, we realize that accrued expense is a liability, therefore it has a credit balance. To close that account, I had to debit the accrued expense and credit the interest account. So now I know that if there's accrued expense, that credit balance indicating a liability will be reversed on the credit side of my interest expense account. Then I will pay for interest during the year. At the end of the year, we still owe 400 Rand, so I will show that the interest must increase with 400 Rand. And the amount that will go to my profit and loss that was recorded in the income statement is 12,900. If I add up the credit side, I get 13,200. So that means the total on the debit side must also be 13,200 minus the 400 will give me 12,800 Rand. And I will show that the amount that was paid out of the bank was 12,800. This 12,800 will be recorded on the face of the cash flow statement. And here I will indicate that the outflow to pay for interest during the current year was 12,800. If we look at the note for creditors, we see that the outstanding amount to the shareholders for dividends the end of the previous year was 12,000. For the current year, it's 20,000. So I will open a ledger account indicating that we owe 12,000 at the end of the previous year and 20,000 at the end of the current year. My opening balance will therefore be 12,000 Rand. My closing balance will be 20,000. That will be brought down at the beginning of the next financial year. In the information, they told us that we paid out a total of 50,000 that was declared during the current year. So this must be transferred to the shareholders for dividends account. And I will debit my ordinary share dividends account and credit the shareholders for dividends with the total amount that was declared in the current year. And that amount is 50,000 Rand. Okay, so they provided that information to us. We didn't have to calculate it. So if I add up the credit side, I get 62,000. So the total on the debit side must also be 62. And if I subtract the 20, it gives me an outflow of 42,000 Rand because we paid for dividends. You can either do a ledger account or you can complete a note for the dividends. If you complete the note, you will show the amount in the financial statements as an outflow because it's on the credit side. The opening balance at the end of the previous year was a credit balance. So therefore, both of them will be outflow negative figures. The 20,000 on the debit side will then be the positive figure to show us the total outflow in the current year. If we look at the SARS income tax amount in the notes, we see that we owed 8,000 at the end of 2016. And at the end of 2017, we paid too much tax to SARS So SARS owes us 2,800. The opening balance is 8,000 Rand. The closing balance is 2,800, but it's a debit balance. So to bring down a debit balance at the end of the year, you first had to carry it over above the total on the opposite side. The income tax for the year was given to us in the income statement as 60,000. So if we add all the amounts on the credit side, it gives us a total of 70,800. So it means the outflow of money to pay for tax in the current year was 70,800. We will show the money that went out of the business for tax in the current year was 70,800, and we will show it in brackets because it calls an outflow. Dividends paid in the current year was 42,000 Rand outflow, and that will give us the total amount that went out of the business in the current year. So we will take into account the cash generated from operations, and we will subtract all these additional expenses that was paid to determine what is the cash flow from operating activities. The total inflow is 110,500 because the money that we received out of cash generated was more than the expenses that we paid. So we have a positive 110,500. Equipment was bought during the year, while a vehicle was sold at the end of the year at carrying value. There was no vehicles bought and no equipment was sold. If we buy a vehicle, we can just subtract the two from each other to determine what is the amount that went out of the business, and you can subtract the accumulated depreciation at the beginning and end of the year to determine what is the depreciation for the current year. If we sold a vehicle, it means that we have to complete ledger accounts to indicate what is the depreciation for the current year, because we have to take accumulated depreciation out of the account as well. The vehicle account had a debit balance of 280,000 at the beginning of the year and a balance of 210,000 at the end of the year. The accumulated depreciation opening balance was 69,200 and the closing balance was 86,400. To calculate the depreciation on equipment, because we didn't sell equipment, it means that we can just subtract the accumulated depreciation from each other, and that will give us the total amount of 16,000 Rand for depreciation on equipment. On the vehicles, they told us that they sold a vehicle. They didn't give us the cost price, they gave us the carrying amount. But because we didn't buy any vehicles, I can balance my vehicles account to determine what is the amount that we have to take out of the vehicles account. So it means the amount that we've taken to the asset disposal was 70,000. Then the totals on both sides will be 280,000, and the balance will be brought down on the debit side, 70,000. The accumulated depreciation, we can determine what is this amount that must go for asset disposal because they said we took it out at carrying amount. The depreciation on vehicles is given in the income statement as 27,200 Rand. So I can debit depreciation with 27,200, credit accumulated depreciation, and then I can work out what is the total 96,400. So it means the balancing figure is the accumulated depreciation that must be taken to the asset disposal account. And that means that the cost price of the asset that was sold was 17,000. The accumulated depreciation was 10,000. So the inflow of money as a result of the vehicle sold will be 60,000 rand.